Hi, everybody. Just double checking with FX Street that you guys can hear me. Great. I can't really see anybody is actually on the line apart from myself and FX Street admin. I don't know if there's a problem with people registering. If FX Street admin could just let me know. Okay, but to get started, well, the key thing obviously is the ISM. There's a couple of things to point out today. We've had a sharp reversal in the dollar. It's been, especially versus the yen. The yen has been weak really across the board now. Dollar yen is hitting a new daily high or new multi-daily high. It's back above that key 80 level. Dollar yen took a bit of a battering, yesterday on the back of a stronger than expected US ISM report, which obviously paid a little bit to the expectations of the Fed doing more QE. However, in the longer term, what that did was essentially boost risk assets, which ended up filtering through to other risky FX, which included euro dollar and also Aussie dollar. So they've recovered a bit from yesterday. It fell all the way down to 132.05 yesterday. Today, it's in a bit of a very tight range to 132.08 and 132. Just below 132.40. So again, it's the yen is the big mover. So let's take a quick look at that then. Just bear with me one moment. Okay. So here we go. This is CAD yen actually. I wanted to show you this because obviously CAD yen the CAD can react very well to positive economic data coming out of the US, because obviously it's such an important trading partner. And what we've seen here is the yen really do incredibly well. The yen having done incredibly well. So we've seen the CAD really kind of sell off in the last few days. Since then, it's made a bottom here. This kind of nice double bottom, real bearish engulfing candlestick yesterday when we got that data out of the US, that ISM data, which really shows kind of a sharp jump higher. That the bulls were very much in control of the CAD then yesterday, and since then we've kind of been trading in a bit of a range. So we went all the way, bounced off 80 to 50 support. And since then been really trading between these moving averages, if you like. So between kind of 81.20 on the downside, and then we haven't quite got to 81.80 yet on the upside. The one thing I would point out, looking at both the RSI and the MACD, is that you should be able to see this now. Is both looking at the MACD and the RSI, they're both starting to look a little bit overbought. So we could be in for a little bit of a bit of stickiness around this level. You can see here we have kind of run into it a little bit. This candlestick on the hourly is certainly coming off a tad, running into a bit of sharp support resistance here at 81.70. As I said, 85 to 90 is the real key level to watch. That's the 200-hour moving average. But looking at it on a slightly longer time frame, it still looks like it's kind of, moving nicely. Again, it's testing that resistance. There's also some daily resistance there thrown into that mix there at 81.70 as well. And of course, the more nearer term high is then 83 using the daily chart. And as you can see on the daily, the RSI has turned higher, so it suggests that maybe on a more medium term, after a bit of a pullback, which would be very normal in the market, we could potentially move higher again. So certainly worth watching out for there. As I said, a bit of incremental resistance on the way up to that 83 high, which we last saw in the middle of, or in the latter end of April. We've also got some, obviously, as I said, 81.70 and then at 82 as well. So could be a bit sticky in that zone between 81.60 and 82. So do watch out for that. Now, the other thing I want to show you is just pure old, plain and simple, dollar yen. I'm going to show you a couple of charts, but the first one I'm going to look at is just our candlestick chart with our moving averages. This is the daily chart. So as you can see, it made a nice, as you can see, it made a really nice bottom there. bounced off good support. So this is the daily chart. So dollar yen bounced off support 79.50. So it did try and test 79.50 on an intraday basis. It got down to 79.64 yesterday before bouncing back sharply on that better toned US economic data. And since then, we really have kind of been moving higher. So that has been the real kind of key there. That shows that 79.50 is a real tough level of support. The bulls managed to punch through 80 fairly, or the dollar bull, sorry, punched through 80 fairly easily. There wasn't too much stress there at all. And what we've seen now is a cluster of daily moving averages around this 81 zone. So again, we're currently trading around 80. 60 has been the high so far today. Obviously, we did have that very sharp move, so we wouldn't be surprised to see a bit of a pullback. Looking at the hourly chart, as you can see, it is a bit in overbought territory. So as we lead up to this 81 level, as you can see on the hourly, there's a lot of incremental resistance. So we've got kind of 80, 78, that type of thing. But looking just at the RSI, the RSI is actually, there's a tiny bit of divergence there on the hourly RSI relative. It's kind of moving sideways, whereas you've got the candlestick still moving higher. So it suggests that, potentially the market could just be taking a bit of a breather. Added to that, on a MACD basis, it's starting to look pretty oversold as well. So, it's all the way at this kind of, 0.7 or 70% level, which does suggest that we could potentially be oversold, so we could be due a bit of a pullback. And as I said, that would completely be normal after the size of the move that we had before. Let's take a look at euro dollar as well. Euro dollar has been really moving sideways, as you can see. Hasn't done too much. It obviously had a sharp drop on the back of that ISM, so again, bearish engulfing candlestick. However, what was really interesting is that there's got a really long lower shadow there, which does suggest that 132 right now is acting as really, really good support. So that's what you should, whenever you see long lower shadows or long upper shadows, usually it works better if you see them on a longer term time frame, but even on an hourly chart, it does suggest that we've hit some near term, it suggests a bit of a near term reversal. So we had that kind of very sharp move lower, but the market wasn't willing to push euro dollar below 132, and indeed 132.05 was the low from yesterday. 132.08 has been the low so far today. So what we've seen really is us trading in a fairly narrow range really in the last, say, 18 hours or so. We've traded with this 200-hour moving average, 131.24 acting as fairly good support. Certainly in the very near term, and then of course a cluster of hourly moving averages acting as good resistance around 132, just below 132.50. So really no movement there at all. What could potentially drive this pair higher? Well, we do have some key economic data releases. We've got the PMI, the April final PMIs for Germany and the Eurozone. We've also got some unemployment data from both Germany and the Eurozone. That comes out at 10 o'clock today. We've also got some auctions coming from Spain, so it could be more of a fundamental move that actually causes euro to shift out of this range. Now, the one thing that we'd point out, looking at it just on the daily chart, there's a lot of triangle patterns that have been about recently, certainly in the FX crosses. Now, they suggest kind of a continuation pattern, but obviously, which does suggest that the price could potentially move higher going forward. But obviously we've got kind of support here at 132.60, resistance here at 132.60 to 70. If we can punch above there, then it may open the way to these 134 highs. But likewise, 132 is holding really nicely as support on the downside there. So do watch out for that. Now I want to look at Aussie as well, because Aussie is also kind of one of these triangle patterns. So as you can see, bit of a triangle pattern, bounced off good resistance there yesterday. It's been a bit in the wars really, the Aussie, because on the one hand we've had the stronger tones of the data, but before that even we also had 50 basis point cut from the RBA, which wasn't expected. So as you can see here, we've got 103.55 is fairly good support, and then below that 103 kind of 35-ish, 30 to 35. Currently testing that support now. On the upside, kind of 104.70 is the high from certainly the last week or so. That's been kind of clearly repelled. We had some really nice move higher last week, but since then kind of fell off. We had if we look at this candlestick more closely, so kind of the penultimate from last candlestick here, as you can see, it's called a shaven head, and that means that there really wasn't too much bullish action at all. The bullish action were more about, the bears were completely in control. That would be expected when you have kind of a surprise 50 basis point cut when the market had only been looking for about 30 basis points cut. And then, of course, right now, the fact that it's testing this support is really key. Aussie dollar, there was a couple of interesting things. Yesterday, after that surprise cut, it didn't really do as much as you thought, as you may think it would have. It certainly didn't fall, didn't make any new lows or break any new ground. Aussie was looking fairly boring. Obviously the dollar was fairly weak as well on one side, so the Aussie resilience in the face of a 50 basis point cut from the RBA wasn't a pure Aussie move. It was also because of some dollar strength. However, if it gets below this 103.30 level, then we may see another test of that 102.50 lows that we saw, as you can see, from around here, so from earlier in April. So do watch out for that. But overall, Aussie really wasn't the most interesting play yesterday. What was more interesting, in fact, was Aussie CAD. So as you can see here, really kind of sharp. This is the Aussie CAD here. We saw a real sharp drop lower. Since then, the Aussie has been doing fairly well, actually. And the CAD has been hit a little bit by weaker than expected PMIs. Okay, cool. Have people had problems getting in to this, to the webinar? I kind of thought so. Okay, that's the FX Street admin. I did point that out, that, yeah, there were big problems getting in. Guys, I'm so sorry about that. Again, I assumed that that there may have been something like that. So my apologies, and also FX Street, I'm sure they send their apologies as well. And let's just hope that that doesn't happen again. And so that everyone's getting, so that password is now fixed, but let's just hope that doesn't happen again for Friday's session. Great. Okay, now we're looking at Aussie CAD, and what I'm basically saying, everybody who's just joining now, is that the CAD was really, the Aussie, was really boring potentially yesterday. Let's go back to Aussie dollar, because I just want to bring this up. Just for those of you who've joined, apologies for those of you who've been in already, but for those of you who've joined, basically, we've had a bit of a turnaround. So the yen is the big faller today. The dollar had a really good rebound yesterday after that really impressive ISM report. But on the other hand, even though that caused the Aussie to sell off and Eurodollar to sell off and cable to sell off, what we saw was that the Dow made a 4-year high. So risky assets were also buoyed, especially in the US, by the strong ISM data, and that really fed through to risky FX, just with a little bit of a delay. So what we've seen is Eurodollar back above 132, cable above 162, Aussie dollar looking less good. But this is basically Aussie dollar, and the reason why I'm showing it to you here is there's a lot of triangle price action going on in the risky FX, in the FX side of things. Okay, cool. So I'm hoping that FX Street are going to reply to a couple of questions there just about getting into these sessions. So basically, there's a lot of triangle price action going on in some of the major dollar crosses at the moment, and that is because we are really kind of caught between two things. So on the one hand, we've got basically the markets are incredibly sensitive to any US economic data. They are look at that, they're basically, after the Federal Reserve sounded slightly more hawkish last week, because they revised up their expectations for growth and inflation. However, on the other hand, not Draghi, goodness, I'm getting my central bank governors mixed up. But on the other hand, Bernanke sounded very dovish and kind of played it down and said that they're still worried. So really, we're looking at every piece of economic data in the US, and we're trying to piece together what the probability of more QE is and what impact that obviously has a huge impact on the market. So on the other hand, what we've got, so on the one hand, yesterday's really strong ISM data was very dollar positive because it reduced the expectation of more QE. But of course, the big news is going to be Friday's payrolls. That's going to be the main thing that we're all looking at. So that's why we're kind of stuck in this kind of triangular price action. Yesterday, of course, we had the RBA cut interest rates more than expected by 50 basis points instead of 25 as expected by the market. It's about 33 was priced in, so it was a big kind of dovish surprise from the RBA. But really, the Aussie was very dull. It didn't break any new ground. It made no new lows. And it was really kind of trapped within this triangle price action. So as you can see, had a nice move higher at the end of last week and then kind of came off quite sharply, but still played out within this triangle. So what we've seen is that it's currently testing support at kind of 103.30, which is key support. If we get back below there, then we may test those lows from earlier in April when we got below 102.50. So do watch out for that. That is kind of an important one. That's a really important support level, so please do watch out for that. We do expect, we think that the Aussie is fundamentally weak at the moment. Our Reserve Bank of Australia they didn't give too much away in fairness in their statement yesterday, but they did sound worried about the outlook for growth and specifically for inflation. And they also said that the Aussie was a bit stronger than what the fundamentals suggested. So, there's a chance for them to talk down the currency. They certainly will do that. So do watch out for that. However, I'm a little bit concerned about trading Aussie US dollar purely because at the moment the US dollar isn't consistently strong. So what we're seeing instead is rather than consistent strength, we're seeing kind of patchiness and a lot of volatility, and that's why we're stuck in these triangles. So I'd rather trade another Aussie cross, if you see what I mean, shorter, and for that I'd probably do Aussie CAD. However, now bear with me one moment, folks. I've just got to quickly right, bear with me one moment. So Aussie CAD, for example, is quite a good one to look at. However, we have run into a bit of support right now. Obviously, the Aussie did fairly well on Monday when we saw. Okay, cool. I think we should be back. Okay, great. We are. So it looks like we're all having technical problems today. But as you can see here, so we've had so Aussie is fundamentally weaker than the Canadian dollar, we think. And so as the market thought, basically since March, it's priced in an awful lot. We are just drawing back a little bit. We're close to an important level. So the kind of the low for the year so far, which is around this kind of 101, which are just below 102 level. That's obviously going to be a sticky level. Added to that, it's going to need to be, it's going to be important for it to be, for us to get some more kind of fundamental data maybe to kind of push that forward. It's going to be important to kind of push that forward. And so we're going to really need to see maybe some stronger, obviously stronger payrolls, maybe potentially to actually push that any lower. Looking at it from a kind of an even longer term time frame, as you can see, really key below that 102 level, really key support level of support there for this cross. On a longer term basis, we're not really, we've obviously had a really kind of prolonged or multi-week downtrend in Aussie CAD, but then below there we have got some resting support at kind of around the 101 mark, and then of course so then we've also got we've got parity, of course. So We've then, obviously, parity being a really key level goes all the way back to kind of mid-2011. So that's going to be a major problem that we're going to look at right now, or a major kind of support zone that we think the market will respect. So when trading Aussie CAD, there is certainly room for further downside. It could be more of a grind lower than a big sharp move lower. Okay, cool. The other one I want to look at, I did look at Euro earlier. I'm just going to go back for the people who weren't here. I know that we don't have much time, and I know today was a bit of a mess up with you guys getting in. So I'll run through this, I'll run through gold, and I'll take a quick look at cable, and then that'll be it, I'm afraid. Okay, let's not look at the weekly. Too annoying, the weekly chart sometimes. Okay, let's look here. So we've got, again, it's just these kind of triangle patterns. So we're currently testing the top. As I said before, 132 held as really, really nice support. So the market, there wasn't even, which I'll show you in a moment, but as you can see, currently the key level to get above is 132.60. And that would potentially lead the way, open the way to further upside, so maybe to 133 certainly, where there's another kind of key level of support of resistance before 134. So really, at the moment, we're kind of in this triangle, but we're testing the top of it, and this is a continuation pattern, so it would suggest that we're going to continue higher, that maybe kind of that 131 level or 130.50 was the low, which we experienced a few weeks ago. So what we're seeing instead is that kind of this nice kind of rounded bottom. So the market really is respecting 130.50. But right now, 132 is holding really nicely as support. And as you can see here, this was the bearish engulfing candlestick. That's an awesome candlestick there. That was the sharp move lower. So this is the hourly chart now. That was the sharp move lower after the ISM. Manufacturing came in much stronger than expected yesterday. But I'm just interested, anytime you see kind of long shadows, either to the upside or to the downside, it's kind of like a warning signal. It's like, beware, we may change direction. So what you're seeing now, sorry, just bear with me one moment. So what we've seen now, we saw a really long shadow yesterday, but just down to 132 and it held, and since then we haven't got below there. So that suggests to me that certainly in the near to medium term, 132 is going to hold as really, really good support there, with obviously there's a lot of kind of incremental resistance levels before we get to kind of 132.50. So there's kind of this 132.35 to 50 area, which is going to be quite a key resistance level. So it could be a little bit sticky. Obviously on the hourly and that we've got no signs that things are oversold. I do think it's encouraging signal actually that 132 held so well yesterday. Okay, let's also take a quick look at pound and then take a look at gold, and then we're going to have to go, I'm afraid. So again, oh, apologies, my voice is gone. It's come off a little bit in the pound, so kind of really repelled at that 163 resistance level is really repelled by the market, suggesting that for now the market's just kind of going to digest what they've got. We obviously had some more weak data coming out of the UK. I often get asked, why is the pound doing so well when the UK economy is back in recession, blah, 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 blah. And of course, there is no easy answer apart from the fact that the pound doesn't have that strong a relationship with the economic fundamentals in the UK. It's a difficult one, but it kind of is what it is. So what we've seen is it kind of a bit of a kind of a rounded, obviously, we found a top now at just below 163. Looking at it on an hourly basis, as you can see, come off quite sharply. Again, we fell quite sharply on that ISM data when the UK, when the dollar started doing very well. But again, below 162, again, really long shadow. What does that say? Warning signal. Even though people, even though the knee-jerk reaction was to buy the dollar, the overall reaction was like, hang on a minute, this is also good for risk. And of course, the pound and this is also what's good for risk is generally not good for the dollar. So a bit of confusion in how the market how the market has reacted to this. Now, someone said that the capital flight from the EU is also supporting sterling, and that is true. And you're really seeing that in the gilt markets and in the government bond market. You're seeing money come out, Spain, Italy, etc., and then some of that money is finding its way back into the gilt market, so into the UK government bond market. And of course, that is also when people are buying gilts, they're also buying pounds. So that's also been pound supported. So very good point. A good observation there. So again, with this, we're stuck in a really, really tight range. 160.50 at the moment seems to be the high, with kind of 162, as I said, the low there. We did test below it, but didn't really seem to like the air down there. Instead, what we're seeing is that we are in a tight range. So we're kind of it's even a 20 pip range at the moment. That doesn't usually last, but we're in a consolidation phase. Right now, very much in the consolidation phase. The uptrend is still there. That's for sure. It really is. But kind of we are in a bit of a kind of a continuation pattern, and that's what this triangle says. So as long as we don't get below kind of 162, then we could potentially move higher. So we could potentially bust above that 163 level, which could potentially open the way to 165. So let me just get rid of some of those lines because they're a bit confusing and annoying. So as you can see, triangle pattern. We're holding triangle support at the moment, which is a really good sign. This is a daily chart as well. So as long as that support level at kind of 162-ish is held, then we could potentially move higher. That's what these continuation triangle patterns actually mean. Okay, let's take a look at gold, and then I'll leave you to get on with your days. So gold really has been kind of in a similar really has been in a similar vein. It's kind of been moving sideways. Nothing too interesting going on because the bulls and the bears have really been kind of at loggerheads really when it comes to the dollar, and of course the dollar has been a big mover is a big driver of gold. The other thing that's a big driver of gold, the other thing that's a big driver of gold is of course European stock markets, and European stock markets have actually been closed the last couple of days, especially yesterday for that May Day bank holiday. So what we've really seen is that there hasn't been too much out of Europe. There hasn't been kind of any stray headlines or negative headlines. So instead, what we're seeing is the market, the gold price be quite stable. Of course, European stock market and the gold price have been moving quite closely, especially the Eurostoxx index. And the Eurostoxx index has been very sensitive to Eurozone sovereign risk. So what we're seeing at the moment is that as we got the minute we have increased levels of sovereign risk, that is actually weighing on the gold price. But for those of you who've joined this webinar quite a lot, as you can see, this is the daily chart. So gold has been fairly weak within its range, but kind of mid-range-ish. Let me just show you one last chart, and then I really will leave you. Okay, bear with me one mo. Because there are these key levels. So as you can see here, or you can't see at the moment, you should be able to see now. Yeah. This is a 5-year chart. So it goes all the way back to 2008. This is a really key resistance level around this kind of 1630 level. So below there could really open the way, certainly to a fall towards that 1526, but also a more prolonged downtrend. And it would kind of be the end of this uptrend. And again, even here you can see, one moment. Again, it's kind of triangle, but we really, it's not really. I mean, we've really been kind of testing the downside. So below 1630 is really the key level to watch. So those of you who have joined, many apologies for the problems getting in today. Thanks for bearing with us, and thanks for joining. And hopefully you guys can see me or can join us on Friday. Again, as I said, the key things to look out for in the next couple of days. Today may be a bit of a quiet session. There's a lot of economic data out. Of course, we've also got the ISM New York ISM. We've also got the ADP number at 1315. And then added to that, we've also got some economic data. So there's a lot of economic data. But tomorrow we've got the ECB. And then on Friday, of course, we've got the payrolls. So that is... So there's a ton of data coming out, but remember, Europe is just coming back in. We're getting a bit of a kind of a mix-ish. We've got a positive open, but there's a lot of event risk out there. Obviously, a lot of economic data event risk today. Again, negative headlines coming out of Europe could weigh on the euro, could certainly weigh on gold price. But as I said, 1630 in gold price to watch out for on the downside. That's the support level, the key support level, and the same with euro-dollar. 132 is the key support level. Below there could open the way to 130.50, but it has held a very good support for now. So I can't squeeze anything more in because I've gone over already. So thanks everybody for joining, and please do join me on Friday.